Central banks around the world are tasked with the critical job of maintaining price stability and promoting economic growth. Theoretically, they are expected to raise interest rates above the level of inflation in order to cool down an overheating economy and bring prices under control. However, the reality on the ground has become increasingly challenging. In recent years, we've seen a confluence of economic pressures, from crop shortages and soaring food costs to skyrocketing fertilizer prices, all of which have made it increasingly difficult for central banks to achieve their low inflation targets. Despite their best efforts, central banks have struggled to regain the credibility they once held, particularly in the wake of the 2008 to 2009 financial crisis. The public has become increasingly skeptical of their ability to effectively manage inflation, and there is a growing sense that the current leadership may not be up to the task of solving the underlying issues. This erosion of public confidence is a double-edged sword for central banks and policymakers. On the one hand, it creates a sense of urgency and a desire for change as people become increasingly dissatisfied with the status quo. But on the other hand, it also undermines the very institutions that are tasked with stabilizing the economy and restoring economic health. Many believe that a significant enough loss of public confidence could even lead to a change in the political leadership, with the hope that a new administration might be better equipped to tackle the challenges at hand. However, this is a high-stakes gamble, and the outcome is far from certain. Another key development in the economic landscape is the rise of central bank digital currencies, CBDCs. While these digital currencies are often touted as the next frontier in financial innovation, many experts believe that they lack a justifiable purpose beyond increasing national debt and expanding the power of central banks. The argument is that CBDCs, by their very nature, are designed to make it easier for governments to borrow and spend, as they can be used to circumvent traditional banking systems and directly fund government initiatives. In a world where national debt levels are already alarmingly high, the introduction of CBDCs could exacerbate this problem, potentially leading to even greater economic instability. Central banks have long relied on a variety of tools to manage inflation, including adjusting interest rates, implementing quantitative easing (QE) measures, and even directly intervening in currency markets. However, the effectiveness of these tools has been called into question, as they appear to be losing their potency in the face of the current economic challenges. Authorities have repeatedly claimed surprise at the stubbornly high inflation rates and other economic indicators, but many believe that this is simply a case of managing perceptions rather than solving the root issues. There is a growing sense that central banks are more focused on maintaining the appearance of control than on implementing genuine solutions. One of the most tangible signs of the economic turmoil we're facing is the steady decline in the purchasing power of many of the world's currencies, including the US dollar and the Australian dollar. This erosion of value is often attributed to the deliberate inflationary tactics employed by central banks and governments over time. By gradually devaluing their currencies, these institutions are effectively taxing the population through the hidden mechanism of inflation. As wages appear to remain the same, people are unknowingly paying an inflation tax as their money buys less and less. In the face of this eroding purchasing power and growing economic uncertainty, many investors and savers are turning to traditional safe haven assets like gold and silver. Unlike fiat currencies, which are subject to the whims of central banks and governments, gold and silver have held intrinsic value over millennia without the risk of counterparty default or sudden devaluation. Gold, in particular, has long been considered a reliable store of value as it retains its purchasing power even in times of economic upheaval. This makes it an attractive option for those looking to protect their wealth and hedge against the risks posed by the current economic climate. The concept of inflation as a hidden tax is a particularly insidious one, as it allows governments to extract resources from the population without the need for direct legislation or taxation. By gradually eroding the purchasing power of the currency, authorities can effectively siphon wealth from individuals and businesses without the public necessarily being aware of the true cost. This practice has become more prevalent since the abandonment of the gold standard, as it has become easier for central banks to manipulate the money supply and influence inflation rates. The result is a system that benefits those in power, while the average citizen is left to bear the burden of the slowly diminishing value of their money. One of the more troubling consequences of this inflationary environment is the widening gap between the wealthy and the average worker. Since the 1970s, we've seen a sharp increase in wage inequality, with CEO earnings rising far beyond the wages of the average employee. This disparity is partially due to the fact that corporations and the wealthy are better positioned to benefit from inflation, as they can more easily pass on rising costs to consumers or adjust their assets and investments accordingly. Meanwhile, the average worker is left struggling to keep up with the rising cost of living, as their wages often fail to keep pace with the rate of inflation. As the economic landscape continues to shift, some experts believe that we may witness a significant change in the relative values of certain asset classes. Specifically, there is a growing belief that overvalued real estate may flip-flop in value compared to undervalued gold. In a hyperinflation scenario where fiat currencies rapidly lose their purchasing power, gold could become significantly more valuable relative to real estate and other physical assets. This would represent a dramatic shift in the traditional wealth-building strategies that many people have relied on for decades. It's important to note that gold and silver are not only valuable as financial assets, but also have a wide range of practical applications across various industries. From manufacturing and medicine to even food production, these precious metals are in high demand due to their unique properties and versatility. This multifaceted demand makes gold and silver particularly reliable as safe haven assets during times of economic uncertainty. Their intrinsic value, coupled with their diverse practical uses, can provide a level of stability and security that may be lacking in other investment options. In conclusion, the current economic landscape is fraught with challenges, from the struggles of central banks to manage inflation to the erosion of public confidence in the institutions tasked with maintaining financial stability. The rise of CBDCs, the diminishing purchasing power of currencies, and the growing wealth inequality are all symptoms of a system that many believe is in need of fundamental reform. As we move forward, it will be crucial for policymakers, central bankers, and the general public to work together to find sustainable solutions to these complex problems. The stakes are high, and the future of our economic well-being hangs in the balance. By understanding the underlying dynamics at play, we can better prepare ourselves and our communities for the challenges that lie ahead. Thank you for joining me on this deep dive into the world of central banks, interest rates, and the broader economic landscape. I hope this video has provided you with a greater understanding of the issues at hand and the potential implications for our financial future. Stay tuned for more content like this, and don't hesitate to let me know if you have any questions or feedback. Until next time, take care.